Hello and welcome to the Teachers Mutual Bank Better Money Management webinar series, where we bring you the information, tools and tips you need to boost your financial well-being, get the most from your pay and work towards those life goals that matter most to you. I'm Betsy Westcott and my greatest wish is that every Australian enjoys financial well-being. It's my belief that the better skills and knowledge that we have around money, the better choices we can make to live a happy, independent, prosperous life. That's why I've dedicated my career to helping people understand and make the most out of their money. I'm a financial wellness coach with qualifications in financial advice, home lending and money coaching. And today we are going to take a deep dive into credit and looking at why being credit healthy is so important to our overall financial well-being. I'll be sharing lots of helpful information and tips throughout the webinar, so you might like to grab a pen, paper or the Notes app in your mobile phone and keep that handy too. But before we start, I'd like to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. And an important reminder for listeners that this webinar is for education and entertainment purposes. It's not financial advice and doesn't take into account your objectives, financial situation or needs. You should consider if the information in this webinar is appropriate for you and contact a professional financial advisor if you're seeking financial advice. So, what are we going to be covering in today's episode? Well, why being credit healthy is important, credit scores and credit reports, the reasons we might borrow and use credit, and the golden rules for getting and keeping your credit score in good shape. Having a healthy relationship with credit is all about using the right type of credit for the right purpose or goal. It's about not borrowing beyond your capacity to repay. So, taking into account things such as your future interest rate rises or changes in life circumstances that could affect your income and your ability to service an outstanding debt. Not spending more than you earn by using expensive forms of credit to fund expenses that you can't cover with your regular income. For example, maxing out your credit card or using things like buy now, pay later to cover everyday expenses. Okay, interesting fact, or is it fiction? More Australians are likely to default on credit cards and personal loans than any other kind of debt. It's a fact. According to a study from the University of Sydney, interest rates, especially on short-term types of credit such as credit cards and buy now, pay later credit, can be really steep. And then there's also the fees as well for things such as late or missed payments. It's important to have healthy credit habits from a money management and debt point of view because debt can start to spiral and really get on top of you with interest continuing to accrue on unpaid balances on things such as credit cards, and it's easy to get further and further into debt. And once you get behind, it can be hard to get on top of that debt, especially if you're on a fixed or low income. Now, I want to reassure you that credit card debt can be useful with good money management, and there's always ways to take control of your finances. Your credit habits now can also impact some of your most important life goals in the future, such as buying your own home, a new car, or even getting a new mobile phone plan. The way you manage your credit affects your credit report and credit score, which is what lenders reference when they assess a loan application to determine how likely you'll be able to repay your loan or debt. Your credit report can make or break your home loan application or any loan application. Your credit report has important information, both positive and negative, about your credit history. Current and historical personal and financial information, including any loans and credit accounts you might have had in the last 2 years, how much you borrowed, and your track record when it comes to making repayments. All past credit inquiries and applications you've made, regardless of whether they were approved. Any credit applications you've made over the past 5 years, any loan defaults, any debt-related legal proceedings will also be there too. And it contains your all-important credit score. Pop quiz time. What is a credit score? Is it how much store credit you have? Is it a numerical summary of your credit history? Or is it how many movies you've starred in? And if you said B, you were spot on. You could think of your credit score as an Uber rating for your finances. Just like your Uber rating lets a driver know if you make a good passenger, your credit report lets your lenders know how responsible you are and how likely you are to be a good borrower. Every Aussie adult has a credit score. It's a number that summarizes everything in your credit report. It can be between 0 and 1,000, or it could be between 0 and 1,200, just depending on the credit reporting agency. The average Australian has a credit score between 625 and 699. But basically, the higher the number, the better your credit score is. And the more favourably a lender will view you if you apply for a loan or credit. If you have a higher credit score, they'll be more confident that you'll be able to repay your loan. I'm going to list a few things as we go through. You might recognise them and might like to have a go at guessing if you think that it would affect your credit score or not. Here we go. A credit card you got a year ago. Yes. The electricity bill you paid 2 days after the due date. No. The car loan you were approved for 4 years ago and always paid off on time. Yes. That time you forgot to pay off your credit card for 3 months. Yes, that will affect your credit score. Your personal details will be in your credit report too. So your name and address, the details you usually use to prove who you are. Not your income, savings or assets, just your credit history. By law, only certain kinds of organisations can access your credit history, and how they handle your information is also stated in legislation. Okay, here's the question. How many Australians would you guess have never checked their credit report? It's 60%, 6 out of 10 according to Credit Smart. But you can get a free copy of your credit report once every 3 months from a credit reporting agency. So it's a good idea to check your credit report regularly, especially if you're thinking about applying for a loan or a line of credit in the next 6 to 12 months. To get a copy of your credit report, get in touch directly with a credit reporting agency like Equifax, Experian or Ilion. Now, we know about our credit report and our credit score and things that can affect whether we have a good or a bad credit score. Let's look at why we borrow in the first place and how we can use credit. As a rule, credit itself is not necessarily good or bad. If managed properly, credit and loans can be really useful financial tools. So let's look at reasons why people get into financial difficulty. Namely, borrowing for the wrong reason, borrowing too much or borrowing beyond their means to repay, or using the wrong type of credit or loan for their needs. So some of the reasons why we might borrow or use credit include to buy things you need or want now rather than save the money to buy them later. You might use credit to invest and grow your wealth, for example, borrowing to buy a home or an investment property. And then finally, you might use credit to help with cash flow timing, for example, when bills are due now but payday is still a week away. Now, for teachers, especially casual teachers and teachers working on contract, managing your cash flow can be tricky because your income can be up and down. There might also be periods over Christmas or on term breaks where you don't have any income coming in, but you've still got those bills and other expenses to pay. Depending on how long your break in income is for, using a credit card to cover shortfall may not actually be the best strategy. A better strategy might be to put aside a set amount of money each week so that you have some savings at the end of your contract that you can draw on. And we looked at savings and saving strategies in more detail in our last webinar, so make sure you dive into that too. There are many different types of loans, which you can learn more about on the Money Smart website. We can group these by expected term length, for example, short-term, medium-term and long-term loan types. An example of a short-term loan might be credit cards, buy now, pay later, whilst a medium-term loan is a personal loan or vehicle finance, and then a long-term loan might be mortgages or investment loans. The golden rule when it comes to credits and borrowing money is to match the life of the loan to the life of the asset. So, smaller items or bills where you're using credit for cash flow purposes or purchases that you can pay off quickly should be matched with short-term loans such as credit cards. For medium-term loans, a medium-term loan such as a personal loan is a great thing to use for purchasing a car or consolidating debt that you can pay off over a number of years. When it comes to buying a home, that's long-term, so a long-term loan such as a home loan will be appropriate. But you still need to be careful about how much you borrow and how you use and manage your credit. The shorter the credit or loan term, the higher the interest rate is likely to be. So that's why you only want to use those on short-term loans or lines of credit for cash flow purposes, and ideally you pay down the balance within the interest-free period, which is usually about 55 days. It also helps to be aware of other credit and loan costs, such as setup or establishment fees, any ongoing fees or charges, potential exit fees, or penalty fees if you make a late or a missed payment. Okay, so what are the top tips for getting and staying credit healthy? Well, only borrow what you need and can afford to repay, allowing for the possibility of future rate rises or changes in life circumstances. If you have any high interest debt, consider consolidating that debt, like what you owe on credit cards, into a lower interest rate loan, such as a personal loan, to save on interest and get out of debt sooner. And then pay down debt as soon as possible and reduce credit card limits. For credit cards and other short-term credit, make sure you pay your balance within the interest-free period. Even just set reminders in your calendar so you don't miss it. Or look for a low interest rate credit card if you don't pay your credit card balance off each month. Be sure to be wary of hidden fees and charges and high interest, which often accompany credit cards with rewards programs like frequent flyer points. Set up auto payments for bills and SMS reminders to make sure you never miss a payment, and have your bills come out of a separate account that's just for bills. Members can do that really quickly and easily using internet banking. Make your loan repayments on time and make arrangements with a lender if you think you might be late on a repayment. Don't have unused credit limits or make unnecessary credit applications. These can impact your credit score. So for example, if you have a credit card with a limit of $5,000, but you only ever really use a maximum of $1,500 of that credit limit, that $5,000 limit will still have a negative impact on your credit score. Making multiple loan applications with lenders, for example, for a home loan or a personal loan, can also have a negative impact on your credit status. So only apply to one lender at a time. Okay, here's some specific tips for keeping your credit report and credit score in good shape. Check your credit score and report regularly. Check that there aren't any credit applications and other things you didn't know about. For example, negative listings, multiple credit inquiries, multiple credit cards with high limits, or any unmade payments. Check all the information in the report to confirm it's accurate, and report any inaccuracies to the relative credit provider for correction. Okay, so hopefully what you're taking away from this episode are some key tips, like make sure that you use credit appropriately, only borrow what you can afford to repay, and make sure you regularly check your credit score to see that it's healthy and accurate. And that's it for today's webinar. Thank you for following along. I hope you're feeling a little more confident and informed about what it means to be credit healthy. And that brings us to the end of our Better Money Management webinar series. If you haven't already, make sure you catch our first and second webinars on budgeting and saving for more money management tips to help you boost your financial well-being. And in the meantime, don't forget to check the website for more tools, calculators, and resources to help you budget better, save, and be credit healthy too. I'm Betsy Westcott. Until next time.